The following is a presentation of TFNN.
All right, welcome everybody to the Options Hour on TFNN. My name is Don Kaufman, host of the Options Hour from ThinkorSwim from TD Ameritrade. As always, this is a call-in show where I can answer really some of your option questions, all of your option questions. In that regard, anything with stocks, options, futures, commodities, give us a call. We are always interested, and we are here, of course, to answer your option-related questions. So, with that, the lines are wide open. Again, as usual, give us a call, 877-927-6648. Got a couple things to discuss here today. One of them, of course, being like Netflix, but hey, what's there to discuss? That stock got absolutely crushed. So Netflix, all of a sudden, a $77 underlying, down $40 in a day. But, that's, I guess that news is kind of broken, kind of done. I know a lot of people when Netflix was in, that 115, 112 range were bottom fishing a little bit. We missed it, meaning that you missed the bottom because we haven't seen really a bottom yet. But again, Netflix losing 800,000 subscribers, getting crushed. And kind of a surprising thing to me would be, in regards to Netflix, and we'll cover a little bit about the general markets here, and of course, take some calls. So, while I'm discussing here a little bit about Netflix and the general markets, give me a call, 877-927-6648, because as always, it's a call-in show, and kind of lonely here, kind of lonely without without you guys calling in. So with that, Netflix yesterday, before the earnings announcement, had a what they call a market maker move, and that's kind of a proprietary indicator on ThinkorSwim from TD Ameritrade. It had a market maker move, which is, for those of you that don't necessarily have ThinkorSwim, it's fine, but the market maker move is a one-day, one standard deviation indication on an underlying that, for instance, like Netflix that's about to have earnings. It gives you a rough estimate of how far the underlying is priced to move via looking at the implied volatility on the options. So you have to assume that option order flow is extremely accurate these days. The options yesterday, before Netflix had the news announcement, the options were pricing in for anywhere from about a $15 to a $16 move, either up or down. Market maker move never discerns which direction we're going to go. All it does, it gives us the implied risk. There's always conspiracies out there that, somebody knows where the stock is going before, the earnings come out. Listen, if anybody knew anything, wouldn't that be reflected in the option premiums? Like if somebody knew that, earnings on Netflix were absolutely going to, actually the earnings themselves weren't that bad, but if the news was really, really going to be horrible, this news sucks on Netflix, you would see that kind of stuff priced in on the options, or specifically, to the stock price. But with all the order flow yesterday, meaning that all the trades that were coming in, how the market maker move works is it takes all that order flow and it disseminates based on supply and demand of the options, how far ultimately, the options are pricing how far the stock can move. And, for the most part, again, yesterday it's showing right around like a $15 or $16 move, which is, that's a pretty drastic move on a $115 underlying. It was pricing a 14 to 15% move. And, Netflix earnings come out, and for all of you conspiracy theorists, hey, it moves, $42 and absolutely smokes the market maker move, which is the market maker move. I say it's a one-day, one standard deviation. What that ultimately means is that, for the most part, one day, one standard deviation, it means that it moved outside the one standard deviation, means 68% of the time it would fall in that range. Well, we actually moved almost three standard deviations outside the norm yesterday on Netflix. So for all of you former engineers, current engineers, or just math geeks in general, it's a pretty interesting move. With that, I think we've got the first caller here, and for the show, and it's Joe from Boston. He's got a question about, looks like Intuitive Surgical, ISRG. Are you there with us, Joe?
Yes. How are you, Don?
Good. How's it going?
Good, thank you.
What you got here on Intuitive Surgical?
Well, I'm in some November 390 calls from.
Yep.
I had a strategy on before the earnings to take me through earnings so I could hold those options, and then what I did is on half of it I wrote the weekly 430s.
Yeah.
And I still have another half that I can do. I just wanted your opinion on if I write the 430s, how would you hedge the downside move? Would you buy the 425, 420 debit as a hedge, or would you buy the 425, 415, to kind of hedge for a downward move? Because ultimately I would like to keep the Novembers as long as I could and keep writing the weeklies against it.
Yeah.
But I wanted some sort of hedge. I just wanted your opinion on how you'd set up that hedge if you were in that trade.
So just taking a look at this, basically what you're riding the November option for the next 3 weeks.
Yeah. Mm-hmm.
Got 24 days left. There is still a pretty significant amount of time premium in the November options, even though they're the 390s. They're deep in the money here. The extrinsic, the time premium left them is still like $4.20. But
Right.
The reality is that you're selling a 430 call against it for you probably sold it for about what, $3-4?
Yeah.
Guessing?
Yeah, which expires Friday.
Which expires Friday, which is out there. Ultimately, you're just, this is what they call a synthetic covered call. You're utilizing the 390s, in lieu of it. To buy put protection is going to be a little bit expensive. And the reality is you're trying to protect $40, or, the real truth of the matter is it's about $34. You're trying to protect about $34 of intrinsic or real value, which is pretty significant to be able to protect. Buying a put spread, even if you bought, for example, like the 380, 370s. Okay.
I was thinking if I bought the
weekly's
weekly,
going to have the greatest time decay though associated with them, unless you go deep in the money, and then deep in the money you might as well just bail out of out of the 390s anyway. So it's a problem that you kind of face. It's with a covered call, the age-old question is on a covered call, how do you protect the downside? Well, you have to do what's called a collar, and a collar is basically buying a put and selling a call to help finance it. But are you in the 390 calls for a decent price? Meaning that
Yes.
you ripped apart some strategy. Are you ahead of the game on them?
Yes. Mm-hmm.
Yeah, that's for the most part, if you're ahead of the game, you might want to consider closing a chunk of that position. It's one of the best hedges in a situation like this.
Okay.
There is
That's why I only did half. I only did half of the 430s. So
Yeah.
I still have half the position I could just close out.
And I've seen this like time and time again where somebody had it as a chunk of a strategy. They left those calls on. But my guess is you got X amount of risk when you first started this strategy in November.
Right. Mm-hmm.
And the truth of the matter is, after you ripped off other chunks of the strategy, you probably have a hell of a lot more risk because those 390 calls are naked long. Your only protection now is selling the 430s against it, but it's only burning like $4. But you have 10 times that amount of risk. You're into an option for almost $40 on those Nove 390 calls. It makes me a little nervous. In Intuitive Surgical, it doesn't obviously sound like that much right now in terms of implied volatility. It's got a 35% implied volatility. Granted, we know, if you know the history of this underlying, this thing has one of the most wild, implied volatilities ever, and it's dollar-wise can move a tremendous amount. Percentage-wise, it's going to move, just like a 35 vol underlying would, which is, almost what the S&P 500 is. But the reality is, in dollar amounts, they're pretty significant moves. I mean, today, isn't. I mean, today with a $2.12 move, we're not talking about much. So
you're there, So you're saying you just close out the other half and just try to, just move on.
Yeah, I would actually consider, taking profits and running, because in this scenario, these deep in the money calls, I would rather see you have some type of a spread on.
Right.
Where you
Well, okay. Mm-hmm.
Yeah, I mean you're technically spreading here. You're buying the 390s in the money and you're selling it some type of a kind of a what I call the bastardized diagonal, but it's just a synthetic covered call.
Right.
It's a lot of risk in a $420 stock.
My theory was originally like, gee, if I can get $3+ for the 430s, then even if I used the entire amount of what I got for the 430 calls that expire on the end of this week, and bought the 425, 415, for 365.
Not that much protection though.
that gives you $10 down.
Right, gives you $10 to the downside, but all of a sudden now, why are you in the strategy?
Yeah. It's not worth it.
You're getting out for nothing. You're capping your upside, and you're not capping your downside. Which, hey, I'm all for having a little bit more risk than reward. That's okay as long as you have a high probability. The only problem is you don't have a high probability in this case.
Right. So your theory is if I close out the other half, then would you roll out and do a November vertical with a portion of that?
Sure. You know what? That's exactly what you can do. And when you look at
or a December, or will you just stick with November? Or is it too close?
How bullish are you? Depends on how bullish you are. Because the interesting thing is, if you look at November versus a December spread here, the November 420. This is an in-the-money call spread. If you were buying the 420 calls, selling the 430 calls, that is a $5.25 debit. Now, there's almost no extrinsic premium in there because it's a $10 wide vertical spread for $5.25. But the 420 calls are already in the money by $5.
Right.
We're at 424. Now, if you look at the November spread, it's trading for 525. If you look at the December spread, it's also trading for 525. So it depends.
So when you see that, what do you do when you see the same price for November and December? You say it's better to do November?
If I'm more bullish in November, absolutely. And if it's like a shorter-term trade, I mean, if you looked at this even for the weeklies, I bet you the price isn't that much different for the weeklies. It's not. Actually, the price is more for the weekly options because the reality is, although this is a $10 wide spread that you're paying $5 for, the spread doesn't pay off until closer to expiration.
Right, I know. The theta burn doesn't happen until the very end.
Right. So the expansion of the spread doesn't happen at the end. So it really depends on that time frame. And buying these in-the-money spreads, it's not necessarily, hey, this is the greatest thing to do. If you're bullish and more aggressive, you have tendency to buy an in-the-money spread. If you're bullish and less aggressive, I would consider selling an out-of-the-money put spread. This is, again, if you're bullish and less aggressive, I would look towards like a 410, 400 put spread. Selling the 410s, buying the 400s, about $2.85. Be careful, though. Bid-offer spreads in here are kind of wide. You could drive a truck through some of these spreads, the bid-offer spreads in here.
Right.
I've got some buddies that trade this, though, and they say it's fairly liquid. So, again, depending on your level of aggression, buy the in-the-money call spread or sell that out-of-the-money put spread.
Okay. And you would okay. So that's how you play it. Yeah.
I mean, it's to me having even $6 or $7 in this case, and if you sell a spread for $2.80, you got almost $8 a risk or $7.15 a risk in here. $7.15 a risk to me seems all right versus $40 a risk. And the $40 a risk, though, doesn't necessarily have a better probability associated with it. And that's, to me, that's kind of the reality of the strategy itself. Is it's as much about probability as it is risk.
Yeah, and that's why I call, so sometimes hearing the different ways to think about it from a probability standpoint work out better because we always get in things and then we think a certain way about it. We're biased, and then that skews our vision.
Yeah, absolutely.
Yeah. Okay,
right,
that makes sense. So, okay, thanks, Don.
All right, thanks again. So with that, we got the lines wide open. You guys can give us a call. Always interesting talking to you, so give me a call, 877-927-6648. There was just a general question here from a listener. Can you trade an account, through ThinkorSwim? And ultimately, what that entails is, so ThinkorSwim, for those of you that are not aware, is ultimately it's part of TD Ameritrade. We're a brokerage firm. Yeah, you can trade directly through ThinkorSwim, and all the tools and analytical tools that I discussed, here, either on, here on TFNN or one of the other chats that we do from time to time, all these analytical tools, we provide them for you. They're all free. All the data's free. the only time you ever pay anything, it's a regular TD Ameritrade account. So, feel free to give us a call if you ever have a question in that regard. That's fair game as well. On of course the options hour. So again, when you guys give us a call today, you can call us about stocks, options, futures. I haven't even had a rundown today of the marketplace. So let's discuss just the markets in general here today. What I'm looking at, and because I know throughout the day here on TFNN, there's quite the variety of guests, and I think a lot of traders look at some different things. I'll kind of give you my take. So E-mini S&P 500 futures. First of all, it's the first thing I always look at on a day-to-day basis. I don't care what the Dow is doing. I mean, the Dow to me is kind of almost obsolete. Marketing over the years has made Dow Jones pretty popular, but ultimately it's 30 underlyings, and I'm not really comfortable with how the Dow is ultimately weighted. So I kind of always talk about the S&P, and specifically the S&P 500 futures, because they are really the leading edge of order flow in the marketplace. So futures are well off the lows today. We're only down 775 in the day. NASDAQ futures are off 1725. VIX is up $1.24. Also, the VIX is off of the highs of the day. The VIX is the S&P 500 volatility index. With the expectations of a large down day, you typically see implied volatility up. The surprising thing is we have what we call the risk-on trade today. The bonds have rallied on the day pretty considerably. So the /ZB and /ZN. ZB is the 30-year bonds. Okay, ZN, of course, is the 10-year notes. And when you see a cyclical rotation of money out of the S&P 500, okay, people utilize today, and when I say people, I'm talking about hedge fund managers, traders, the professional side, has tendency to utilize the bonds as a bit of a hedge in the marketplace today. So you're seeing a lot of capital flowing out possibly of some of the equity markets and, of course, into bonds. Now, the one thing that's also in play today, we have not seen this in a while. Gold. Gold's in play. Gold's up $50 today. So this is very much a risk-on trade. Gold had completely fallen off the radar screens in recent weeks after gold collapsed down a few $100s in a couple of days. Gold is back up to $1,700, and today gold seems to be this risk-on trade, meaning that ultimately there's a perception of risk in the general marketplace today. Obviously, there's a lot going on in Europe, and please, this is not about Netflix, because Netflix, sucks and loses 800,000 subscribers. By the way, I tend to utilize TFNN in a bunch of the chats I do to get back at every service that has ever charged me more for any subscriptions. So that and a couple other services that I don't like. But no, I'm a Netflix subscriber, and I lowered my subscription because the thing's getting ridiculously expensive out there. Anyway, with that, sorry about that, Netflix. You were at 300, and now you're in the 70s. That was an absolutely brutal move, though, overnight. So shareholders just ripped them apart there. Anyway, with that, you're seeing, again, a lot of risk coming to the marketplace by means of people are out there buying bonds. They're buying gold. So a little bit of a risk on. You're also seeing oil up another $2.63 today. Oil is more of a turmoil trade, we'll call it today, than risk on or off. So as the Mideast has apparently some turmoil or risk in the Mideast always equals higher oil prices. So you're seeing oil obviously up, and silver is up as well. So with that, let's actually jump to another caller. We've got Bob, and he's got a question, I think in RJF. But anyway, are you there with me, Bob?
Yes, I am.
Yeah. Is it the symbol RJF? Do I have that correct?
Yes, that's correct.
All right. So, okay, it's Raymond James. Yeah. It's not an underlying I look at a huge amount, but fire away. What do you got?
Yes, I have a fairly large position. I was wondering how would be a good way to hedge it, or to increase some yield on it, or covered calls or whatever. We do have some restrictions on what we can do as far as buying or selling. Ultimately, I would like to hold it, but I was wondering if there's any way to get some more return out of it.
So I'll tell you a couple of different perspectives here. When as soon as you mention restrictions, if you work for the firm, there may be restrictions also in regards to trading options in and around this. I know myself, working for a financial firm, being licensed. Obviously, we've got considerable restrictions about trading in and around specifically the equity of the firm I work for. And we're also limited to some of the financials in here. So that's a restriction that you definitely want to check, within the broker-dealer there. Now, on Raymond James, there are options in here. The bid-offer spreads are extremely, extremely wide. So what the price is in here is anybody's best guess. You'll see that, I don't know if you look at the option chain right now, the December, for instance, you've got December 30 calls. There is some implied volatility in here, meaning that the stock is literally $30, on the money. You could go out and sell a 30 call. My guess is a 30 call would probably trade somewhere in the neighborhood of about $1.50, which is, between now and 52 days from now. It's a December option. That's not half bad for reducing some of the risk. Typically, when you're vested in one of these stocks longer term, you look at risk reduction not as necessarily buying puts for protection, not in buying, some people, view puts as a kind of almost like an insurance contract, but ultimately buying puts, it gets extremely expensive, especially when you have to hold the stock or you're planning on holding the stock for a considerable amount of time.
Right.
You're possibly better off in selling calls as an enhancement to ultimately reduce some of the downside risk.
Okay.
Yeah, so that's, obviously consideration. But again, you've got pretty wide bid-offer spreads in here. Now, there is one other scenario that you could take a look at. Let's say that you're restricted in this particular stock. And I get this question a lot. So I deal in a little bit on the professional side with some of our money managers, and they have clients all the time that are, I've got a client that's, works for a major, major oil firm. Well, guess what? They can't trade any of the options within this firm, meaning that they work for a major oil company. They can't trade any of the options. They're actually literally, involved in some of the financials of the company. So what do? And the answer is, in their particular case, we're actually reducing risk by means of an ETF. This is a financial company. Raymond James is a financial company.
Right.
Any of the financial companies, it might track something like the XLF. And the XLF is an area.
Right. I know it. I'm familiar with it.
Yeah, so it's an area, and in fact, it tracks it very, very closely here. The XLF has got massively liquid options, and in essence, you could go out and you could construct a variety of different option strategies. The only difference is when you use the XLF, you probably have to use some type of spread to reduce margin. So you might have to sell, for instance, like the 14 calls, buy the 15 calls, or buy the 16 calls to reduce some of the margin in there. It's not a huge amount of premium. But again, you have to figure out the XLF has got a slightly higher volatility than does Raymond James. They're like 40% versus 48%. But the XLF is a $13 underlying versus a $30 underlying. So, for instance, you own 1,000 shares of Raymond James, you may have to trade 20 contracts, double the number of contracts in the XLF versus, Raymond James because, again, it's a $13 underlying here versus a $30 underlying in your stock. So it's all about a ratio then at that point.
Okay.
Yeah. So anyway, there's a couple ideas for you. You got anything else for us?
No, that'll give me something to work on here. I'll find out about the restrictions and then start doing some math here.
Yeah, I'll tell you what, the restrictions, they suck in the industry, but it all has to do around Sarbanes-Oxley.
Right.
It really depends. Obviously, they consider a little bit of insider trading because in the end, selling a call could reduce some of your downside exposure because if they say that, yes, you can sell a call, what's to permit you from, or to limit you from selling a deep in the money call? Because if you sell a deep in the money call, that reduces all your downside risk. And over the years, there's been a lot of that going on. So that was the reduction of what you can and can't do. But, hey, listen, XLF, man, nobody's going to restrict you there. Nobody even thought of that stuff. Yeah. All right.
Okay.
Thanks for the call, Bob.
Thank you very much. Thanks, Don. Bye.
Thanks a lot. So with that, lines, again, they're wide open. By the way, I'm also, of course, reading the Tiger Den. So if you guys are in the Tiger Den over here, feel free to chat in. I see a couple people kind of going back and forth here a little bit. There's always the what I call the usual suspects in here. G7, Trade, Zetad. I don't even know how to pronounce some of these. Wes is in there. It's always the same monkeys week after week. So anyway, you guys, if you're in the chat room, feel free to chat to us any questions you may have. But again, of course, the number here is 877-927-6648. All right. Choking over here, but let's take a couple more questions as we go along. As I was discussing here, a little bit, about markets in general here and what we have tendency to look at. So the futures right now, again, are down 650. And as I said a moment ago, people always chatting about this, but the futures have tendency to drive order flow for the marketplace, meaning that ultimately, when any trades are done around the world, they have tendency to be hedged in the futures products. And when I say futures drive order flow, because ultimately, when a futures product moves, for instance, the E-mini S&P 500, when it moves, it has ripple effects, obviously, through the entire S&P 500. The stocks specifically in the S&P 500 move typically in tandem with, of course, the S&P 500 futures. So regardless if, for instance, Apple had a news announcement right now, and Apple breaks to the downside, if Apple starts to break to the downside, that actually has an effect back on the futures. If the futures, for example, have a break to the upside or the downside, that then in effect has a movement on the entire S&P 500 and or specifically Apple. So the question is always, which is it, the chicken or the egg? Does Apple, for example, and I'm using Apple as an example because it's a large market cap in the S&P 500, does Apple move the futures, or do the futures move Apple? And the question is, well, both. Okay, both. But the dissemination of order flow is instantaneous, meaning that when the futures move even a half a point, a quarter point, it instantaneously generates buy and sell orders into every component stock of the S&P 500 in real time. In fact, I'm going to bring this up in terms of active trader really quick, and I'll show you guys something kind of interesting. I'm going to pick on Apple for a moment. If you're kind of watching along over here with the, I've got a screen show up right now. There is a component on ThinkorSwim. It's called Active Trader, and there's an aspect of Active Trader that I sometimes discuss, and that's called time and sales. Now, I don't look at this thing very often myself, but I use it to kind of give people the idea of how order flow works and how order flow is generated, meaning that let's say the S&P 500 moves right now. Well, as the S&P 500 futures move up or down, there are servers all over the world tied to those futures products. And when I say tied to the futures products, ultimately what that means is as the S&P 500 futures move, that generates buy and sell orders into every component of the S&P 500 literally in real time to keep the stocks in the S&P 500 ultimately moving in tandem with the primary underlying futures product. So the reason that time and sales is so interesting is all you see throughout the day in time and sales is showing you who's buying and who's selling. And I don't specifically mean who's buying, like, hey, it's this guy over here. It just shows you all the buy and sell orders. So when you look in here, the greens are the buys, the reds are the sells, and you see order flow ticking through. But I know some of you guys are not watching kind of the screen show right now on Tiger TV. But ultimately, all you see going through here is 100 shares, 100 shares, 100 shares, maybe 200 shares at most. How come there's nobody trading big? Today, it's all about hiding size and hiding your order flow, meaning that if you're a professional trader and you want to sell, if you literally want to sell 50,000 shares, you're never going to show anybody that you're 50,000 offered. You got to be just insane to do that. If you wanted to sell even 10,000 shares, you're not going to display to anybody that you're trying to sell 10,000 shares. Okay? Professionals today break up their trades using algorithms that basically do what's called spray order flow across multiple networks out there. And that basically entails going out there and chunking up trades, maybe 100 shares at a time. As a trader, on some of these professional platforms today, all you do is you put in, I want to sell 10,000 shares and give an average price. So right now Apple is trading, at $389.27. And all you got to do is tell, I want to sell Apple shares. I want to sell 10,000 shares at an average price, let's say, of $389.70. And it'll start spraying away, and it'll take the 10,000 shares and it'll chunk it up to 100 shares at a time, and it'll spray it across different marketplaces. So for those of you that are always looking for the big trades going through there, you're not going to see it anymore. The world is changed, and very few people ever, get into the technology side of this business. Since I've been talking about Apple here, there's only a handful of large trades that have gone through on Apple. The interesting thing is the handful of large trades that have gone through an Apple, the vast majority of them have been retail trades. How do I know when they're retail trades versus professional trades? Well, retail is allowed to trade in odd lots. Okay, professionals have to trade in round lots. That is, okay, when you're a professional or designated institution, you have to trade in 100-share blocks, 100, 200, 300, 1,000, 1,200, so forth and so on. If you're a retail customer, you can sell 273 shares. I just saw 273 go through over here. And it's really easy to pick out the institutional order flow. Whoops, here's one right here, 110 shares. Who's that? That's you. That's you at home. 110 shares. You're kept in one lot. But it's really easy to pick out, the institutional order flow versus the professional order flow. And again, people are like, well, why does this matter? It's important to start to understand how order flow works today to get a better feel for markets in general, especially for those of you guys sitting at home and trying to trade on an intraday basis. People still look at things like time and sales and NASDAQ level 2. And NASDAQ level 2 is who's bid and who's offered. But the reality is today it's very much a server-driven marketplace. It doesn't necessarily matter what a trader is saying they're bid or offered for, meaning that how many they're trying to buy and how many they're trying to sell. Because the reality is somebody may say they're trying to buy 50,000 shares, when the reality is they have a computer on the other side of it unloading 50,000 shares. So they're saying I'm a buyer of 50,000 when they're really a seller of 50,000 and using some type of an algorithm behind that. And people say, it's an advantage. It's not an advantage. I mean, come on, what do you care? Today Apple's going to trade, few million shares. It doesn't ultimately matter, but it is important to discern how order flow is generated today. So with that, feel free to give us a call at 877-927-6648. Hey, we need your calls here because it's pretty boring just talking to myself as the hour goes by over here, whether it's a stock question, an option question, a futures question. I love talking about futures products as well. I think it's, listen, I'm not here to tell you guys, you have to trade futures, but I am here to tell you, you really need to, at the very least, look at futures, because without them in today's marketplace, you have a tendency to be a little bit blind to what's ultimately going on in the, the greater picture of order flow in general. So, with that, I see somebody's chatting in that there's, this is exciting stuff, snow in the forecast for New York City on Thursday. Yeah, that sucks. It's still 98 degrees out here in Scottsdale, Arizona. So although I was always based in the Chicago office, the reality is I don't live in Chicago. And you ask why? I was there last week and the weather sucked. So by the way, feel free to chat that in there as well. There is a question that kind of came in, and it said, Don, can you talk about fixing broken naked put trades? So the trade was this, and I'm going to kind of pull it up because I've seen a couple of people asking about it. There was a trade, excuse me, on Netflix. Netflix, $77.59. Where was Netflix yesterday? Well, a hell of a lot higher. The trade, as it pertained, was there was a lot of people going out there and selling the 85 puts. Now, the 85 puts, and I'm going to guess they're actually for the month of November, so let me open that up. The 85 puts for the month of November, they're trading for like $11.55. So people are like, well, what were these things trading for yesterday? On ThinkorSwim, what I'm going to do is I'm going to go to ThinkBack. It's a backtesting tool, but the reality is I don't really backtest very often. And the reason is simply when it comes to options, what do I care what an option was priced at yesterday? It just doesn't really help me. The option price yesterday had to do with what the risk was yesterday. Obviously, the world has completely changed place today, especially for Netflix. But the one thing I do utilize this tool for here is ultimately in backtesting. I'll go back and I'll look at good trades gone bad. So the 85 puts yesterday were trading for about $1.70, $1.80 in that kind of neighborhood there. And so yesterday, when Netflix closed at $118.84, it was the last traded price yesterday. Today, obviously, it's $77.59. The 85 puts were trading for about $1.70, $1.80. And ultimately, today, they're trading for like $11. And people always ask me, well, first of all, if you sell a naked put, the only easy way to say this is you have to be willing to wear the stock. That is, you got to be willing to buy the stock. And if you're not willing to buy the stock, this is a lot of heat to take. So you, on the 85 puts, you sold them for anywhere from $1.70, let's say $2, and you're being put stock at $85, and you will be put stock here in the next couple of weeks at $85, but your ultimate purchase price is about $83. Now, there's nothing wrong, per se, with the sale of the naked put. You just have to be willing to buy the stock. And in this particular case, how can you limit losses? Well, number one is when we come closer to the expiration, if there's very little time value left in the 85 puts, okay, you can roll those forward into December. And, if you don't want to roll those forward, you're rolling forward the short naked put. And that's to prolong the inevitable that is being put to stock. But if you're still bullish, and that has to be your take right now on Netflix, if you're still bullish on Netflix, okay, it's all right to hold the naked short put. If you're panicking, can't take the heat, can't take the margin, can't take the risk of the stock, okay, then you have to consider closing either the whole trade or a portion of the trade to mitigate some of your risk. Because this is no joke here in Netflix. This stock has gone from 300 to 78, and a lot of us had this ultimate belief that, in that 115 range, it was showing, some pretty decent signs of life again. A lot of us thought, like, hey, when it cracks to 115, it's already had, the living crap beaten out of it. It can't possibly get any worse, but it did. It got significantly worse in Netflix. So you have to ask yourself, is this, forming kind of the bottom? And when you look at this company, it's like, man, can it really get any worse than this? Well, now it's on, meaning that, yeah, it can. So we've already seen that. And, of course, the stock has actually rebounded off of its lows today. The lows were 74 and change. Wow, man, just got absolutely crushed today. So there isn't necessarily the easy fix, per se, out there. You can roll it forward or close a chunk of the trade. I wish I wish I had the right answer for you. And maybe we just, bounce back up to some degree, but you can turn around, you sell a call against the naked short put. Now, you're, for the most part, you're selling a call, wouldn't really absorb too much more margin, but it's ugly out there because selling a call has tendency to lock you more into the trade, meaning that now you've done one bad trade, it's going against you, you sell a call, you're marrying yourself to that position now by really amplifying what you've got embedded into the position. By the way, selling the call definitely reduces some of the risk. I don't argue that at all. It definitely reduces some of the risk. If, for instance, you sold, the call in there as well, but and it recaptures some of the premium that you've been kind of hammered on. But again, it also embeds you deeper into this particular trade, and it has to be the call, like whether you think this stock is going to rebound or not. I'll tell you, there's a lot of people believe that absolutely we're going to rebound. And after the beating like this, investors may jump back in and try to bottom fish the stock a little bit in the short term. So something to think about. All right, so with that, I'm going to jump to a caller. It's Jim in Palm Harbor. I've talked to you before, Jim. Are you there with us?
Yes, I am. How are you doing?
Good. How's it going this week?
Not bad. Can't complain. I actually, if you look at the TZA, which goes up as the IWM goes down, the Russell goes down. If you wanted to buy 1,000 lot, you're talking heavy capital. If you want to buy calls, the implied volatility is really high. So what I've done many times is just sell naked puts on the weekly.
Yeah.
Especially on a Tuesday or Wednesday. And I guess I have several questions. I actually sold the October 34 weeklies right now at
34 puts.
Right.
Okay.
Slightly in the money. Looking for the the erosion of premium, and hopefully we get back over 34. At what point in time do you say this is on a 10 lot right now? It's up $150. At what point in time do you say, hey, I ought to clean out this trade, pocket $300 or $400, and move on to the next?
This actually is, you see, I look at this trade as more from like that risk perspective. So you sell this put in here. Obviously, you've got a pretty decent down move in the markets today. To collect $150 in a 10 lot, I don't know if that's enough. And the reason I say I don't know if that's enough capital here is that the risk you're absorbing can be pretty significant because in the weeklies here, we're looking at 122% implied volatility.
Right.
If you extrapolate that move out, it's serious. The move on a day-to-day basis in here should be $1.26 or greater. And you are absorbing a lot of that risk in those 34 puts, which, hey, we all get it. That's what the weeklies are about. when I say look at this a little bit from risk perspective, I would worry first about what are you going to do if this thing blows up in your face, because it very well could.
Well, I'll sell the weekly call against it, and I've actually looked at that, either selling 33 for either 190 or 2.
Yeah.
Now premium erosion will really happen big time between now and tomorrow afternoon.
Yeah, for sure. And the one thing again I always think about in here is if you get a 3 standard deviation move in a week, it's obviously it's going to hurt. So always look at the kind of an exit, in terms of if this thing kind of blows up. So I've always been a big advocate, if you're selling the options naked, be willing to wear, the stock to some degree, be willing to buy the stock. So you've got to keep that in perspective on this on a trade like this. When you're selling naked premium, it's that risk management side is going to be critical, but you need to collect quite a bit of premium here to make this worthwhile. So you're going to need obviously a move in your direction, which you got today. I mean, you got a $1.50 up move here, which is even outside of its its normal kind of trading range on an intraday basis. So I don't think necessarily what you're doing is a bad thing at all.
Well, I'm bullish on TZA now. The only other alternative is to write a call spread, and I just didn't know, though, the premiums are so high. If you thought TZA was going to make a big move between today and tomorrow to the upside,
yep.
How would you construct a call spread right here?
You could actually buy a slightly in-the-money call spread to limit some of the extrinsic premium if you're trying to be a little bit more aggressive about it. I'm pricing some of them right now to give you an idea. Here's here you go. Here's a 33-35 call spread, just to give you an idea. You're buying the 33 calls in the weeklies, selling the 35 calls in the weeklies. The entire trade, interestingly enough, and some people don't like to buy spreads, but the trade is going for 80 cents, but the trade is already in the money. The 33 calls are already in the money by 82 cents, so there's no extrinsic premium in here. And the trade risks approximately 78 cents to be able to make $2, of which you've already paid out 75 cents up front. You got, total profitability here of $1.25 approximately. And this trade will mature, in the next day or two as the weekly comes closer to the expiration. But this, when I say it's more aggressive, this, for risk-reward ratio works out a little bit better than the sale of the naked put. The sale of the naked put, from a probability perspective, looks great. But we all know that the sale of the naked put absorbs just a hell of a lot of risk on that last week of expiration, whereas this call spread, it doesn't absorb as much risk. 76 cents of risk in here to make $1.25, and the trade literally has a 50-50 shot. But if you're bullish...
How would you analyze the difference now between that weekly, which expires this Friday, versus the Novembers, which expire in 3 weeks?
Interestingly enough, they're probably priced almost identically. They, the Novembers are actually trading for even a little bit less. And so why is the November 33-35 call spread trading for less than the weekly call spread? And the reason is the weekly call spread is already expanding out coming into the expiration, where the November options have got a lot of time, meaning that ultimately if you do this trade for November, the 33-35 call spread for November, you need us closer to expiration before the $2 wide spread is going to become valued anywhere near $2, even if the spread is deep in the money. Okay. Whereas on the weekly options, with 3 days to go, that $2 wide call spread is already starting to widen out closer to $2, as it's already in the money by 78 cents.
Okay.
Yeah. So
But it just doesn't. I'm looking at the November right now. The November 32-35.
Which is also, the November 32-35 also doable. It's a little bit deeper in the money there, and it's trading for 95 cents. It's also viable. Again, you're buying a $3 wide call spread that's already in the money by $1.81, and you're only paying 95 cents for it. So this basically time value is in your favor in this particular trade here. Yeah, this is almost the same as the trade I just mentioned a moment ago here, but with the November spread. Just keep in mind, even if it's deep in the money, let's say that, for instance, TZA rips from 30, almost 34, where it is right now. Let's say we rip up to 37. This $3 wide call spread isn't going to mature that much.
Right.
All right. So you're going to have to sit there, and you're going to have to wait so much closer until expiration. And you can figure that out by, you can look, for instance, at the 29.32 spread right now. The 29.32 It's the same spread. It's a $3 spread, but it's just deeper in the money. And the 29.32 spread with the underlying trading almost at 34, it's only going right now for $1.68. So hey, you'd still be able to double your money almost out there. Not a half bad idea.
I'll look at those pairs then, and thanks for your help.
Yeah, thanks a lot. Thanks for giving us a call today.
Bye.
All right. So with that, some excellent call-ins today. Everything from TZA to Netflix. Hey, I'm not sure Netflix is a great thing to talk about, only because the stock got crushed. Hey, my question is, has anybody out there been on the right side of the Netflix trade? Always curious here. So I always talk about good trades, bad trades, and good trades gone bad. Which one do you have? Obviously the market maker move yesterday kind of got blown up considerably, meaning that Netflix exploded here outside of its normal market maker move, its normal standard deviation on some bad news. And that's something, with a lot of earnings coming out that I always kind of discuss from time to time is taking a look at some underlyings that, obviously when they have earnings coming out, taking a look at what we call those market maker moves. Like you see on TZA, obviously there's no earnings coming out on TZA. It's the inverse of the IWM, but it's showing a market maker move there of like $1.40 almost a day. That's pretty big move, especially for a $33 underlying trading 125% implied volatility. Yeah, that's pretty crazy stuff right there. So with that, futures right now down 11. That's ES futures down 1150, Nasdaq futures down 22.25, Dow futures down 78, VIX up $1.37. And again, you got a little bit of a risk on trade here with the bonds up and gold up a pretty significant amount as well. And again, gold's been just dead in the water, and all of a sudden is coming back to life. Gold trading now right at that level of 1,700, which seems to be an area that it's having a little difficulty kind of cracking through throughout the day over here. So with that, taking a look at markets in general, my expectations kind of moving in towards the latter half of the day here is that markets continue to actually sell off a bit. I know we saw a little bit of a rally back over there. I call that rally back. Anytime we rally back like midday, I always call it like the noon balloon, just a little order flow that comes in and buys, we sell back off. But with bonds up as high as they are, listen, this market has been absolutely resilient in the face of kind of all kinds of adversity within the last approximately 2 weeks. I mean, you look at the S&P 500, and we've ripped to the upside. So you have to have some expectation of some degree of pullback here. I would guess before moving forward. But let's give you a little bit of a broader take. Although here in the short term, I have an expectation of a little bit of a pullback, there's some interesting things I'm looking at a little bit longer term, and that is, you saw the S&Ps, specifically I'll talk about the spiders for a moment. You see the spiders, they move from, the area of like 107, 108, rip all the way back to 124. I mean, how often do you see these, 10% plus up moves in such a short amount of time? I mean, it's over the 10% up move. It's just an incredible, upside move. Even with the sell-off today, we're still up well over, 10, 12% in just, the last 2 weeks. So there's obviously a lot of naysayers, in the media. Oh, we can't possibly sustain this. Now, yeah, although I believe in the short term here that we're probably going to have a little bit of a pullback. Okay, one of my kind of greater beliefs is that when you look at the markets in general, how much cash is literally on the sidelines, and people have been talking about this for years right now, but bottom line is bonds, okay, and treasuries. Look at treasuries in the U.S. versus, for instance, some of the bonds over in the European marketplaces. What you have is bonds in the U.S. marketplaces and our treasuries are paying literally next to nothing, okay, in terms of interest rates. And then you have, of course, bonds over in Europe paying ridiculous interest rates with the threat of default in a few of the Eurozone countries out there. So the reality is, when I look at this, there needs to be some equalization of bonds in the U.S. versus bonds over in Europe, in that is a type of an arbitrage trade, in that, literally there's traders going out and borrowing capital against, here in the U.S., paying almost next to nothing, obviously, for interest rates here in the U.S. and turning around and hopping on, some of the rates that are being paid out in Europe. And there will be an equalization period as soon as the Eurozone crisis, kind of abates. But the other perspective idea here is simply this. When you see capital coming out of the bonds, all right, where's that money going to go? And, yeah, of course, it can equate into some of the European bonds. People come in and buy some of the Euro bonds, and as they start to sell U.S. bonds, buy some of the Euro bonds, and see some of the interest rates kind of flatten out across the board. But you also can see massive amounts of capital coming into the S&P 500. Always keep in mind the bond markets are absolutely massive in comparison to the S&P 500 in terms of a market capitalization. The T-bills are just, phenomenal. They're over double the size of the U.S. equity markets out there, and that's a reality that you've got to keep in mind because you think we're up right now, we could absolutely tear to the upside. Because when you think about bonds, when these bonds start to sell off, there ain't going to be any buyers. Okay, because right now behind a lot of the U.S. Treasury markets, of course, is the Fed. There's a lot of European banks dumping money into our bonds. Why are they dumping money into the bonds? Because they don't trust their own damn bonds. So the reality is keep your head towards those bond markets because, again, when they do start to sell off, there ain't going to be any buyers. Who wants to go out and buy a bond and make 2%? Yeah, everybody's going to take that giant step back, and the only one that's going to be buyers is going to be like in movie Trading Places. As the market was getting crushed in Trading Places, they're like, buy, like every 30 seconds there. So something to keep in perspective here for the coming weeks, coming months, that the S&P could sustain a fairly massive upside rally. To me, I literally see risk in the marketplace is to the upside. And listen, I'm not a guy that's usually a bull at all, but, at some point, things come back into line. You'll also see the VIX has sustained a rather high level for a significant period of time. Something to keep your eye on. Risk could come off a considerable amount in the VIX as well. Of course, as risk starts to abate, S&P 500 typically is in a rally mode. So a lot of risk trades on over there. With that, as always, I thank you guys for joining us for the Option Hour this week. Thank you, everyone, for calling in. My name is Don Kaufman from ThinkorSwim from TD Ameritrade, joining you every week for the Options Hour at 12 noon Eastern Standard Time on Tuesdays. Thank you guys very much for joining us, and be back next week. Thanks a lot, everybody, and bye-bye.